Hey everyone, this is Marshall, aka the ThetaTrada, and first let's go over some channel updates. So obviously you can see me now. I'm hoping that the audio and video production of this channel just looks way better. I got a better microphone. Obviously I got a webcam so you can start seeing me. I'm actually going to start editing the videos. I was taking them all in one take and just uploading it straight to YouTube, so we're actually going to get some good transitions in and things like that. So I hope you guys all enjoy that. Second, this is going to be the first video in a series of videos that are really aimed at beginners, really understanding what it means to buy an options contract, sell an options contract, and really just get their feet wet with options trading and just become more familiar with the terms and, I don't know, repetition into what all that actually means. And thirdly, down below in the description, there's a link to the spreadsheet that I have for going over my weekly account reviews. I post all my trades there, so and I literally update it every day. So if I make a trade, it's in the spreadsheet. So I encourage you guys to all go look at that. Also down below, we'll be doing a presentation shortly. The link to this presentation will be down below. And lastly, if you feel like supporting the channel, my Robinhood link is down there as well. So if you haven't signed up for Robinhood before and you want to start options trading, I mean, that's where I got started. I think their UI is very user friendly, and I think the app is super awesome. Plus, all options trades are free. So if you want to sign up with the link down below, that would be awesome. All right, with that, let's get into the video. All right, so in this video, we're going to be going over just the basics. What are options? What does it mean to buy an option and things like that? So we're not going to get into any advanced topics like what are the Greeks or how do you open up a diagonal spread or anything like that. This is simply going to be the buy side of options and what all that means, and maybe some important terms and things like that that you guys need to learn. So if we look at the first slide here, there's some option fundamentals. So what even is an option? Well, your option is a right to buy or sell 100 shares of a stock at a given price on a given date. And options are divided up into two main categories. You have the call side and you have the put side. And options are made up of three main parts. You have the strike price, which is the price that the option will be executed at. You have the expiration date, which is the date that the option expires. And then you have the premium, which is how much the option is currently trading at. So let's look at the calls versus puts. The calls is your right to buy 100 shares of a stock on the expiration date at the strike price. And the option premium increases as the stock price increases. A purchase of a call represents a bullish sentiment of the stock, because if this premium is going to go up as the stock price goes up, then obviously you want the stock price to go up because you want to make money on that option. And a call is considered to be in the money when the stock price is above the strike price, and out of the money when the stock price is lower than the strike price. So if you look at puts, it's basically going to be the exact inverse of a call. So when you buy a put, that's the right to sell 100 shares of a stock on the expiration date at the strike price. The option premium increases as the stock price decreases. So a purchase of a put represents a bearish sentiment of the stock, because as the stock price goes down, your put is actually going to be worth more and more money. So you're betting on the stock going down. A put is considered out of the money when the stock price is above the strike price, and in the money when the stock price is lower than the strike price. And we'll get into why all that happens, and I got an example coming for what all that looks like in the real world. So now let's get into option premium and how that is actually determined. So an options premium is determined by two different parts. You have the intrinsic value and the extrinsic value. The intrinsic value, if the option is in the money, the intrinsic value is going to be the difference between the strike price and the price of the stock that it's currently trading at. The extrinsic value is the time value associated with the option. Since options expire, sometimes even years out, that gives the option more time to go in the money, and that time is actually associated a value. And it's also important to know that you're going to see like an option worth like $1.50 or something like that. But since an option is a contract for 100 shares, you have to multiply that premium by 100 because that premium is going to be applied to each share of that 100 shares. So let's look at an example about how we'll pick out the extrinsic and intrinsic value of the options premium based on this example right here. So we have our underlying, which is just the stock that you're buying the option against, basically. So we have the underlying XYZ here. We have the current stock price, which is in blue at $11. Our strike price in red, which is at $10. And the options type is a call, and this expires about a month out. And this option premium is $1.50. So if we want to go and calculate the intrinsic value or the extrinsic value, the first thing we need to decide is this option in the money or is it out of the money? We can determine that this option is in the money because since it's a call and the current stock trading price is above our strike price, that is what considers a call in the money. And then we calculate the intrinsic value is the difference between our strike and the current trading price. So since there is $1 width between our strike price and the current trading price, of this $1.50 premium, $1 of that is the intrinsic value. Then we can do some simple math and figure out that 50 cents of this $1.50 is the extrinsic value or the time value that is associated with us having 1 month until the option expires. Now let's take a look at the inverse of this. Instead of a call, if this was a put, again, we'd run through the same steps. Is this put in the money or out of the money? Well, since the current stock trading price is above our strike price, this put is 100% out of the money. Thus, we can infer that $1.50 of this premium is extrinsic value. And if the stock price does not drop below the $10 strike price, this option will expire worthless on February 19th in a month. So I think after looking at how an options premium is actually calculated, I think this will be a good time to go over and just see a real world example about how this all actually works. So we're going to look at SPY, which is basically the S&P 500 ETF here. And we're going to go to trade options. This is in Robinhood, by the way. Most of you will probably have the app. This is the desktop version, but it looks literally the same exact way. So right now you can see that we're buying calls here. So that means everything that is below the share price is considered in the money, and everything that is above this share price is considered out of the money. So if we look at something like this 380 call right here, this is worth $5.15. Now again, you have to multiply that by 100. So this options contract here is worth $515. So if we do the same thing that we did in our example, this is for 380 and the current trading price, let's say, is 384 just for easy math. So basically $400 of this $515 here is intrinsic value. That's how much is actually the difference between the strike price and the share price, which means $115 of this is just based on the time left between today's date, which is the 26th, and the expiration date, which is the 29th. Also, what you're seeing here is called an options chain. And it's called a chain because there's one expiration that we're looking at. There's a whole bunch of strike prices that we're looking at. I mean, this is SPY, so it has as many as the eye can see, you know. And we can change this expiration date, and we can go really, really far out. Like there's some down here for 2023, the very end of 2023. Or we could go just a few days into the future and just see the price differences here. So 380 on the one that was expiring closest was $550. 380 just a few strikes or a few expiration dates ahead is now worth $631. And again, that's because of that extrinsic value. The further you go out, the more extrinsic value is actually going to be there because you have more and more time for that option to get more and more in the money. So that's why they have to assign this time value to the option, because who knows what's going to happen during that time. Either it's going to go way, way up and become more and more in the money, or it's going to go way, way down and you could possibly become out of the money at that point. So I just wanted to show you guys what an actual options chain looks like and how you can differentiate what's the intrinsic value, what's the extrinsic value. Again, these up here that are above the strike price or above the share price, 100% of this $203 right here is all extrinsic value. This has no intrinsic value. If everything else stays the same by February 3rd, this will expire worthless and you will lose 100% of the money that you put into this, whether it's 203 or let's say you go and buy 10 of these, right? So you could lose $2,000. So just wanted to give you guys a real life example and just show you how this all actually works with a real options chain and things like that. Next, let's look at what happens at expiration for an option. So if you have a call that is in the money, at expiration, the call will be what is considered exercised, and you will buy 100 shares of the stock at the strike price, regardless of what the stock is trading at currently. You will buy it at the strike. If the call is out of the money at expiration, your call will expire worthless and you will lose 100% of the premium that you paid. Now, if we look at the put side, it's basically the exact opposite. If your put's in the money at expiration, your put will be exercised and you will sell 100 shares of the underlying at the strike price, again, regardless of what the stock price is currently. And if your put is out of the money at expiration, the put will expire worthless, and again, all of your premium that you paid will be lost for that option. So again, let's look at company XYZ here and see what our option would be at, what would happen to our option at expiration. So again, we have our strike price in red at $10 and our current stock price in blue at $11. And this is a call. So at expiration, our call would get exercised and we would buy 100 shares at $10 a share because that's our strike price. And we would instantly realize $100 in gain because that would be the difference between our strike and the current trading stock price times 100. We would make $1 a share on 100 shares. Again, if we look at the inverse of this and say this is a put and not a call, if we look at this again, the put is out of the money, meaning that our put expired worthless, and whatever premium that we paid for this put, we lost 100% of it because it expired out of the money. So now that we know conceptually what's going to happen with an option at expiration, let's look at a real world example and just figure out the few scenarios that are going to happen. So let's fast forward time to April 16th and let's choose this 390 call that costs $1,056, and let's just go through the couple scenarios about whether it expires out of the money or in the money, and let's see how this one would play out. So going even further into that, let's say April 16th happens and the share price is still at $384. Well, in that case, our 390 call again would be out of the money and we would waste $1,056 and we would lose 100% of that premium that we spent trying to buy this call. So let's assume the opposite. Let's assume that it's not at 384 on April 16th. Let's assume this SPY goes up to $400 on April 16th. That would mean that our call would be in the money and it would be exercised at the $390. So you would buy 100 shares at $390, but the stock price would be worth $400. So technically you could sell those shares immediately right when you got assigned them, and you'd be able to sell them for $1,000 because that would be, you'd make a $10 difference per share times 100 shares, so $1,000. But would that really be worth it? Because we paid $1,056 for the right to buy the shares at $390. So our break-even stock price is $400.56, which would mean we would actually lose $56 if we instantly got assigned, and then sold at the $400 mark. So that's just something to take into account and keep track of, is your break-even stock price, because even if you get assigned the shares, it might not be worth it to immediately sell the shares once you're assigned, because your break-even, you might be below your break-even and you might actually be losing money on the trade. So after going over all that, I know that was kind of heavy, and I don't know, I try to keep it as simple as possible, but if you guys have any more questions, please let me know down below. I did want to call out some important terms, and you're going to be hearing these all the times in the options world. So just to reiterate them, the premium, that's just going to be the cost of the option. You have the strike, which is the stock price that the option will be exercised at. You have the underlying, which is basically just the symbol that the option is bought against. So if it's Apple, AAPL, things like that. In the money, this is used to describe an option that is currently able to be exercised. Out of the money describes an option that cannot be exercised currently. Next, we'll go over the bulls and the bears. Bullish just means you have a positive sentiment on the underlying. Bearish just means you have a negative sentiment on the underlying. And exercised, the call or put has expired in the money, and the purchase or sell of those 100 shares has occurred. Next, we'll go over some options FAQs. So, do I have to hold the option until expiration? You absolutely do not have to, and I would say probably 99% of option traders do not hold until expiration. If we go look at our options chain again, this 1056 390 strike that we looked at for SPY, this is going to go up and down all day, just like the stock price. If we actually look here at this percent changed, it actually changed negative 1.68% today. So if we actually drill into this a little bit, we can see that previously this closed at $10.74, and its high today was actually at $11.10, and its low was $10.36. So I would say 99% of options traders try to capture this the same as a stock. They would try to buy this when it's low, maybe try to buy it at $1.36 and sell it at its high at $11.10, and then you would, profit, roughly $70, $74 right there per one that you had. So I would say, no, you don't have to wait until expiration. You don't have to assign the shares. You don't have to buy the shares. You don't have to sell the shares. If you just want to buy the option and sell the option, I would say 99% of people do that. Plus, a lot of people, if you think about it, you're basically spending $1,000 to have control of $100 or 100 shares of this stock. A lot of people don't have $39,000 sitting around, but they might have $1,056 lying around. So should I purchase options that are in the money or out of the money? And this is a good question. This is something that I would say is probably one of the most asked questions that I've ever gotten, and that's completely up to you. Usually if you buy out of the money options, you're hoping to make money on the extrinsic value. I would say if you buy an out of the money option, you're most likely not going to hold until expiration. And if you buy in the money options, you're hoping to make money on the intrinsic value of the option. So you would basically buy the option with there already being enough intrinsic value there and hoping that that intrinsic value increases in price. Can I exercise an option early if it is in the money? Yes, you absolutely can. Going back to this example here, if this was a call, this would be in the money right here, and you could exercise this immediately, but you would be losing this 50 cents in premium and a month of time. In this month of time, it could go to 12 or 13, but you just cut yourself short and exercised it at only $1 when you could have made $2 or $3 by the time it expired. So yes, you absolutely can, but it's usually not recommended because you lose that extrinsic value of the actual option. So why trade options instead of owning just a stock? Well, going back to Robinhood here again, it mainly comes down to leverage. I can control 100 shares of SPY at $1,000, but I may not have $39,000 laying around to actually control 100 shares. So it mainly comes down to leverage. Like I said, I can buy 10 of these, but there's no way I have $390,000 sitting around, and a lot of people do not have that kind of money. So it's basically just a way to utilize leverage and get into stocks that you otherwise couldn't afford. Can I buy and sell options in the pre-market or after-hours trading sessions? This is absolutely not allowed. You're not allowed to buy and sell options in after-hours or pre-market or anything like that, which sucks because sometimes there's really huge swings in the stock price and your in the money option now becomes out of the money and there's nothing you can do about it. You just have to sit there and wait until the next day. All right, well, that's the end of the presentation. I hope you guys all found that really informational, and I hope that kind of inspired you to get into options trading yourself and at least become more familiar with the topics and the jargon that comes around it and things like that. Like I said, I'll be linking this down below. You can get the presentation if you have a Google account. You can even copy it over to yourself, so you don't have to keep on clicking on the link. It'll just go to your Google Drive account. I would say, like I said again, this is going to be the first part in a lot of beginner style videos. I know I got 2 more coming up, which is going to be the options Greeks is going to be the next video, and then we only discussed the buy side of options this time. But next time, in the third video, we're actually going to go over the sell side of options and creating the contracts that other people buy and things like that. So I don't think I have anything more for you guys. I hope you guys really enjoyed the video. I hope you guys found a lot of value in it. And I'll see you guys in the next one.